Okay, I think let's get started. Welcome to the fifth and final seminar in the current Stephenson Harwood series, M&A in Times of Disruption and Transformation. This webinar will focus on distressed M&A. I'm Adam Crossley, a partner in the private equity team at Stephenson Harwood, and I'm joined by our guest speaker, Stuart Deacon. Stuart is a managing director with Alvarez and Marsal and leads their national special situations M&A practice. He's an expert in stressed and distressed M&A transactions, working extensively with the distressed debt and equity buyer communities. His recent rescue transactions during the COVID-19 pandemic have included the sale of DW Sports Gyms to Frasers Group and the sale of Deltic nightclubs to Recon, a private equity-backed European operator. I'm also joined by Ian Benjamin, a partner in our restructuring and insolvency team, who acts for a variety of stakeholders across distressed transactions and turnarounds. Sophie Schultz, a property litigator specializing in all types of property disputes with extensive experience in landlord and tenant and insolvency related disputes. Daniel Margolis, partner in our banking and finance team, specializing in leveraged finance, M&A and general debt advisory work. And Nicholas Stretch, partner in our management incentives team with over 25 years experience advising on employee incentives and executive remuneration issues for both private and listed companies. The seminar will start with an overview from Stuart on the current state of the market and predicted trends, and then our expert panel will give their insight from the perspective of various stakeholders. If you would like to ask a question, please use the Q&A function. The seminar is being recorded and will be available on our website after the event. Over to you, Stuart.
Thanks, Adam, and thanks for your kind introduction, and really looking forward to participating in today's Stephenson Harwood webinar. So let me set the scene, if I will. After Brexit in the UK, a global pandemic and now war in Europe, and suggestion of a pending global recession, I wanted to start this session by asking, why has there been such a low level of activity in distressed M&A to date? And the short answer is, in my view, that the government's supportive measures have been highly effective, but that distress is coming, possibly coming really soon. And importantly, the business and investment community needs to be prepared to deal with this and the opportunities that we present, playing what is a really important economic and social role in business rescue. So as Adam said, I've been asked today to provide a short backdrop to distressed investing, distressed M&A, under the theme of M&A in times of disruption and transformation, which will then lead to a more focused discussion of various different areas by the distinguished panel in front of me. Globally, we've just witnessed the longest equity bull market we're in history. It started back in 2009, and yesterday officially the US went into bear market territory, with the S&P having fallen more than 20% for a prolonged period of time. During that period, investment capital availability has been at its highest level ever, but then a significant number of macro events have unsettled the economy here in the UK and then globally. And just as a reminder of that perfect storm that we've experienced, it's been a painful Brexit for the UK economy, with ongoing complications on borders and tariffs. The UK is planning to ditch its part of the Northern Irish Territory Protocol, and the EU is just about to commence legislation to be able to, legal action to be able to deal with that. Then we've had a global pandemic that's still ongoing, remember, with large parts of Asia still in and out of lockdowns. We've then had the commencement of a war in Europe, and importantly, the polarizing of democratic and autocratic regions who are central to our supply of goods, services, and natural resources. In our client work here at Alvarez and Marsal, we now see this filtering into the business environment via, firstly, some major supply shortages and supply chain dislocations. That's in the labour market and materials, and that sees a reversal of just-in-time type strategies to near and onshoring. We've seen an increased cost of funding through increased lending rates, as those inflationary monetary controls have been put in place, and we see the end of quantitative easing stimulus in UK, Europe, and now with the US Fed. And borne out by recent surveys, we're seeing an ongoing weakening of confidence and sentiment from the consumer, and that is now passing through to the B2B community. And within the consumer, we're now seeing the consumption of those rich COVID savings and a realization and a dawning, if you like, of the inflationary impact on disposable incomes that has now arrived. But to date, the level of distress, despite this perfect storm, has been relatively low and somewhat predictable. In our experience, it's included energy companies. We're involved in 8 of those 12 that are currently in administration at this moment in time. That's as a result of limited hedging strategies, but difficult to hedge when you're dealing with the highest fuel prices ever and oil heading towards $150 a barrel. Right from the outset of the pandemic, we saw retail and leisure with its typical high operational leverage, and we're going to hear a bit more about that later from Sophie, really challenged at a time where you're not able to get the consumer into your stores. And we've even seen some sad failures, have we not, in important charitable foundations, such as that as the recent failing of Operation Raleigh. The key feature of those rescues that we've been involved with at A&M has been the prevalence of trade rather than the distressed investment community. And rescues by sophisticated buyers in retail, restaurants and bars, leisure, have been driven by ultimately consolidation in those markets. Adam mentioned in his introduction a couple of the deals that are relevant to that in my own experience recently. The first of those being the acquisition by Fraser's Group, Sports Direct, of DW Sports gyms. And then secondly, an industry consolidation of nightclubs with Deltic Group, the largest independent nightclub operator in the UK, being acquired by private equity, but via an existing trade platform in the Nordics. So interesting to see not a role there for the typical distressed investing funds that we might normally see in those kind of occasions. As we said before, why so few failures rather? Well, put simply, the government support has been excellent in helping to prop up the economy during this difficult time. But what we have now are some heavily indebted companies, adding to the increased cost of funding, reduced access to capital, inflationary environment to navigate, potential recession to come, etc., etc. It's our A&M house view, I think shared by many investors at the moment, that probably Q4 2022 this year will see an uptick in distress, probably starting within the mid-market and working its way up into the larger corporates. And just for me to finish, where do we see that? Where do we see those sectors being particularly hot? Well, we see that being continuance of the trends around energy and energy consumptive businesses. We continue to see challenges for traditional businesses in retail, leisure, R&B as discretionary spend continues to shake out. We're starting to see that working its way through into manufacturing and supply chain. And then ultimately, with the increase in interest rates and borrowing costs, we see real estate as becoming challenged. So we see that distressed investor community, which is a significant level of dry powder globally. It's got over about 150 billion of dry capital available to invest. We see those investors really gearing up and getting themselves ready for an interesting investment period in distressed M&A to come. Adam, back to you.
Thanks, Stuart. So an uptick in distressed investment activity is expected, but clearly there's a number of stakeholders involved with different perspectives and motivations, not always pulling in the same direction. So it may help hinder or indeed force a process to take place. But just touching on heavily indebted companies, Daniel, where does this leave companies in terms of the future impact on their ability to borrow?
Yeah, thanks, Adam. As Stuart and you say, the last couple of years have left companies far more indebted than they would have expected to be, taking a lot of liquidity onto the balance sheet, and in an economic situation that is much more difficult and potentially going to get more difficult than would ordinarily support that level of debt. To just touch on the government support measures, in my view, a good news story, if you can call it that, over the pandemic is the way in which governments, debt providers and other stakeholders were willing, or if not willing, were at least able to work with borrowers to help them through those unprecedented times where in many cases revenues, if they didn't come to a complete standstill, it came to a near complete standstill. Those support measures were a huge deferral of fixed costs, many of which remain on the balance sheet. Landlord moratorium for rent, which I know Sophie is going to come on and talk about shortly. Balance sheet fixed cost deferrals on tax supported through HMRC grace periods, furlough for employees, and of course, as Stuart mentioned, the huge government debt initiatives. Thinking about what we saw at Stephenson Harwood and our borrower and lender clients, in the larger clients, we saw CL bills going in, then C bills, of course, for the slightly lower cap clients, bounce back loans, and more recently recovery loan scheme, which of course comes to an end at the end of this month. So through the pandemic, that was what borrowers needed. They needed to take that liquidity onto their balance sheets, and lenders, saw that as an absolute must. Especially those hit hardest by COVID, who are most likely struggling pre-COVID in any case. Businesses such as the one Stuart has mentioned, and physical retail, other businesses reliant on footfall, travel, hospitality, restaurants. That's what they needed to give them a chance to plot their way through the pandemic and the restrictions on earning. A period of great intervention, and obviously it lasted a lot longer than everyone thought it was going to, but always going to be temporary in nature. And as the support finishes, as it's due to at the end of this month with the recovery loan scheme ending, lenders, I think, will be stepping back, and borrowers are stepping back and assessing the damage done to their balance sheets. In the UK, the sense is that the pandemic is behind us, but as Stuart mentioned, we've sort of jumped out of the frying pan and into the fire with cost of living crisis, supply chain issues, which of course were ongoing, and of course war in Ukraine. So where I think that as support was ending, the original hope would have been that from lenders and borrowers alike would have been that earnings and revenues heading back towards pre-COVID levels. I think in many sectors, earnings revenues are still very much on the back foot, and don't look like they're going to get back to pre-COVID levels anytime soon. So thinking about the journeys that some of our clients have been on the borrower side, and where they've ended up. Covenants amended throughout the pandemic pretty much on a running basis, as everyone realised that the restrictions were not going to end as quickly as they hoped. Lenders were very flexible through the time, and doc controls really looking at minimum liquidity, minimum EBITDA, debt service coverage, all focused on just pure liquidity to ensure that a functioning and liquid business was there to come out of the pandemic as best it could. So lenders are now seeing borrower balance sheets which have been massively distorted by the liquidity on offer, and that is money that is not being reinvested in the business. It's not funded growth. It's not funded product development. It's just funded companies standing still as best they can, and funded earnings generated as best they could over the last couple of years. I think we've seen that the leveraged finance market is still open to good borrowers, to good credits and good sponsors. But even those borrowers who are able to access those traditional cash flow borrowings, they don't have much headroom in terms of mistakes going forward. Lenders will be assessing whether borrowers can go forward into any sort of growth period, in the expectation the hope that would bring around any kind of organic deleveraging, or if the business can indeed handle a traditional refinancing when the pricing isn't necessarily that which is offered by a government-backed scheme. And purely from a debt finance perspective, and I know we're going to come on to talk about other types of creditors and stakeholders during the course of the discussion, if I can call it a positive for many borrowers, certainly in the lower mid-market space, who've been borrowing C-bills or recovery scheme loans, is that the length of the government-backed funding was up to 6 years. So many borrowers haven't yet had to address a refinancing need, which means that tough decisions in terms of what next phase of the debt cycle looks like. They may not yet have been needed to be made, although they're being thought about, and borrowers will be wondering when the right time to go into the refinancing market is. CL bills were obviously for a shorter term. CL bills were obviously for a shorter term, and there are of course borrowers who had existing debt pre-pandemic. They've got no choice. They need to refinance. They need to go out and look for that next debt package. The leveraged finance is, as I said, it's still open to good stories. I think the strong wave of M&A activity through 21 and into the beginning of 22 has supported that. And it may just be that sponsors, investors have had to shift their targets from where they might have been before the pandemic, in terms of, maybe they were looking at a very favourable debt market and looking to recap, release equity, just restructure the capital and the balance sheet slightly. And now the stories you're hearing is they're quite happy to take the debt that's on offer as long as the price is sensible. I think for the type of borrower this discussion is concerned with, they'll need to be more flexible in their solutions, looking to rebuild those balance sheets, working alongside lenders, working to rebuild the working capital, and looking at any way to fund growth, to get out of a recessive or at best static earnings period. Our colleagues in the Stephenson Harwood finance practice who work on asset-based lending, they anticipate that market is going to tick up as borrowers look to explore options other than traditional cash flow lending. And then obviously there's been a good amount of fundraising in the distress and special situations space over the last couple of years as well. And that may drive rescue finance packages, or indeed M&A rescue transactions of the type that Stuart's been involved in. So borrowers are going to have to take a step back. They're going to have to be flexible. There will be choices for some, but not for all, I think. I'm interested to hear what others think. My sense is that maybe lenders won't be driving defaults, and but defaults and distress opportunities will inevitably come. Question: will it be the tidal wave that everyone once expected?
Thanks, Daniel. I noticed the headline in The Lawyer this morning said restructuring lawyers are hovering by the bat phone. So there seems to be an expectation, as Stuart mentioned at the start, that if not a tidal wave, that uptick is definitely coming. Ian, does what Stuart described resonate with what you've seen and indeed are seeing in the market at the moment?
Thanks, Adam. I'm hoping for a bat phone, but we'll see whether management will sign off on it. I'd agree with Stuart on the sectors, definitely. And if I take a step back and use, for example, retail as a good example, because of that. One, it obviously is the sale of goods, but also it's the real estate angle as well. Retail was already under pressure as far back as 2017. If you remember in the cycle, you had very large companies under pressure and CVAs abounded back in 2017 onwards. I think Toys R Us was one of the first ones to put itself forward and ultimately fail. But there were other large ones that attempted to restructure their property holdings, House of Fraser being another good example, before ultimately falling into administration, and some were picked up and some weren't. So retail was already in a tough place, due to the online market being so strong at the time, and upward only rent reviews for a sustained period had impacted those. But you then, COVID hit 2020, and retailers are forced to react even further, because initially, obviously, government measures weren't quite in yet. Furlough was being introduced over that summer, and you saw significant collapses throughout 2020 and 2021. Some of them were collapses such as Debenhams and Arcadia. Others were able to right size through pre-packs and come out the other side in some form or another. You think about Monsoon, Jaeger, Oak Furnitureland. There's a list as long as my arm that went through processes to right size their property holdings and their debt. But then once the government introduced further legislation later in the year, SEGA, which introduced the restructuring plan, you started to see larger businesses attempt to take on that process as a sort of CVA on steroids, if I use that term loosely. And you saw large property-based retailers or people in that business, such as Pizza Express, Virgin Active, and so on, attempt to restructure their real estate holdings using the restructuring plan to a fair degree of success, but also to a fair degree of chagrin, which Sophie will no doubt come on to from a landlord perspective. You fast forward now to 22, 23, it's hard not to see there being more to come for businesses in that bricks and mortar sector, whether it's retail or hospitality, leisure, and so on. Particularly in the mid-market, where companies haven't been able to take advantage of restructuring plans because they are not inexpensive. And you've got to have a certain level of balance sheet to be able to afford to even attempt something like that. So down in the mid-market, companies haven't dealt with what Stuart and Dan just referred to, which is that now significant build-up of debt, rent, tax bills, and so on. You then sort of flash forward to all the other issues that now face businesses, so cost of supply chain, material sourcing, labour issues now, which have been exacerbated even worse than in Europe, where COVID has impacted labour resourcing across Europe. We've also got Brexit, which has led to a mass exit of people who previously were prepared to take that work. And you look at the higher operational cost, there's more to come. The other example, which I think nicely crosses over between two of the sectors Stuart mentioned, i.e. real estate and retail, is shopping centres, which are sort of, damned if they do and damned if they don't, because they're both retail focused, but obviously also real estate focused, and have struggled tremendously over the last 18 months, 2 years. And there has to be more to come in that space as those sorts of businesses try to transform what they're holding to more mixed use, more hospitality to increase footfall, and also more the redevelopment and housing sector and so on, to try and counter the fact that a lot of those shopping centres that were built for towns when they thought they were going to grow. And these shopping centres on occasion are much too big for the towns they're in and are not getting the level of fall that they would like. And that's a serious issue. So banks are now having to face up to taking control of a lot of those assets to work them out, even though it's going to be at a significant loss. So just to close on my thoughts, I don't see a tidal wave as much as the lawyer has obviously headlined it today, but I do see a steady flow. I can't see how that isn't going to increase, and I'll pick up on that further on in the talk. Thanks.
Thanks, Ian. So, Sophie, I'd be interested in your thoughts on the landlord's perspective on this, and in particular, what approaches have you seen them taking during the pandemic, and has that approach started to change at all in recent months?
Yes, so I think it is an interesting question. I mean, I echo everything that Ian has said about the problems that retail in particular has suffered. And sort of going forward from there, I think landlords had a particularly tough time during the pandemic because the government protections that were brought in for businesses had the effect of depriving landlords of almost all of their remedies for unpaid rent. And of course, most tenants couldn't afford to pay rent while they were closed or furloughed or whatever. And therefore, most landlords were forced into a position where, they've agreed rent concessions with tenants that covered the COVID period. And landlords, indeed, I think as a class have reacted very reasonably and, responsibly in doing that. But things have changed now. There's only some sectors, such as particular retail and leisure, still have limited continuing protections for historic arrears, but certainly for renters it falls due, it's back to normal. Landlords have got all of their remedies back. And I think market's starting to pick up in some quarters, and landlords are going to give tenants who can't afford to pay the rent still short shrift. They're going to be looking about for alternative tenants who can give them an income. And therefore, I think tenants who can't pay the rent are likely to receive kind of reaction from landlords who are going to be looking to forfeit, i.e. to terminate those leases or issue winding up petitions against tenants. Certainly we're seeing clients losing patience and looking to take those sorts of actions. And therefore, it may well be, as Daniel said, that the lenders are being, not being the tipping point, but it could well be the landlords and the rent roll costs, which are forcing businesses into either a distressed M&A or indeed even an insolvency process.
Thanks, Sophie. So, Ian, I think it'd be helpful for us if you could maybe give us your thoughts in terms of what actually happens in these kind of distress situations, and how likely are they to end up with administrations and CVAs?
Sure. I think, look, it's interesting because I think the government so far has been loath to see, mass insolvency. The reality is that whilst the tap has been turned off and is about to be turned off in various circumstances, both Daniel and Sophie have mentioned, they want to avoid sort of mass insolvency, and that puts pressure on two different stakeholders here. HMRC are going to be under pressure not to just go looking for everything that they haven't been paid, and they're going to have to be far more measured in their approach, which is something that I think goes against previous, we say, policy, or not policy, but certainly previous approach. They can't just go with the old, you owe me money, I'm issuing a winding up petition. I think they're going to be encouraged to be more constructive in their approach. And the other key creditor that's going to be put under pressure now is the clearing banks, because whether they are clearing banks to landlords or clearing banks to borrowers and retailers in the traditional sense, they're going to have to, I think, be asked to sort of look at things and support in the best way they can. Now, I do think as a result of that, you'll see more attempts to resolve things consensually. No one wants to use an insolvency process if they don't have to. There are significant costs and reputation issues to consider depending on the business. So I do think you'll see businesses attempt to engage with stakeholders early if they're getting the right advice, and attempt, to restructure their debts, attempt to restructure their property holding. It's no coincidence that in a lot of situations, you had, back when CVAs were being put out in 17, 18, 19, you had some landlords who took the approach, I won't talk to you if you want to do this consensually because I don't want to be seen as a soft touch in the market. And therefore, if you come with a CVA, I've kind of got to deal with it. Whereas if you come to me sort of back channels to try and negotiate, I may not do that because I don't want every single tenant of mine trying to do the same. And I think it will be horses for courses. I do think that some landlords will take the approach that I don't like a CVA, and Sophie will probably concur with that from a landlord perspective, but nevertheless, no one wants to have to deal with them. And actually, if we can cut deals as landlord and tenant relationships, we'd rather do that outside of a process, as long as it's economically fair to both. And that's tough in this market, I appreciate, but nevertheless, it depends on the unit and depends what the landlord wants to do with it, as Sophie will come on to. So I do think that will be the first approach. However, inevitably, I can't see every business being able to do that. One, because it takes time and money, and sometimes you haven't got the lead-in time to do that. And sometimes, therefore, you're looking at, do we propose a CVA, or more likely, do we look at administration to right size and leave behind leases that we know we don't want? But we've got to be comfortable we can come out the other side of it, because unless you know that you've got certain landlords who are going to play ball, depending on your property holdings, it's a really tough aspect to deal with, because there's costs associated with coming out the other side on negotiating with key landlords and ransom creditors and suppliers, depending on your business, plus keeping hold of staff. So it's not a decision taken lightly, but I can't see how we won't see, obviously, an uptick, which has already been shown in the statistics of the lawyer today. Administrations and liquidations are increasing. But in the alternative, as we were talking about earlier, all that dry capital, as Stuart referred to, with those distressed investment funds, they're going to look to deploy and take advantage of the situation, either through asset purchases out of insolvency, or indeed share purchases if that business is just in need of liquidity. Because I expect access to capital will retreat from the current levels that have been out there that kept the likes of Daniel so busy over the last couple of years, because I think natural lenders are going to be a bit more nervous in that market and pull away from it a bit. And that's where the distressed investors, whether they're equity or debt investors, will be able to take the opportunity to sort of pick up in that market and deploy some of that cash. And that'll be, the next stage in my opinion.
That's really interesting. I think it's a really interesting question how the real estate piece interacts with what you've been saying, Ian, because I think there is a lot of sort of interplay there, and that the real estate is often the biggest cost for a business, and therefore the strategy taken there and the approach that the landlords in response take is key. And you described, I think, and I agree with what you said about how consensual negotiations will often be the first port of call. And indeed, we've seen quite a lot of landlords be prepared to entertain that where there is a sensible business plan. And landlords can, be a bit of give and take with a lease re-gear, where the tenant can agree a longer lease term or to remove break rights to give a longer term certain, which has therefore got more value, more investment value for landlords in return for a rent concession or rent free. And so we've also seen some switch towards turnover rents. So there is a piece there in terms of the negotiation piece, but obviously landlords are out to optimise their own position, and it's very much going to depend upon both the personality of the individual landlord. Some are more consensual, some are more aggressive, and also what the alternative is for that particular asset, in that landlords don't want their assets to be sitting there without any income, and have they got a better tenant prospect out there that they can go and get in the market, or indeed some assets will have redevelopment value, where if they can get the current tenant out, they can do something that's going to make more money, particularly things like retail, where perhaps they may want to position it. We see some attempts to sort of reposition the retail offering. So it's very much sort of case by case, I think. Obviously, if you are in that sort of distressed situation, how are your landlords going to react, and what are your options? If you want to try and reduce your real estate costs, you're probably not looking at a share sale, because that's going to involve obviously the buyer taking on the entire liabilities of the business. You're going to be looking at either doing a CVA first, perhaps then combined with some sort of outside investment plan, because a CVA will enable you to compromise the future rents to reduce your rent roll, or an asset sale where the buyer can cherry pick assets, whether or not that is a pure asset sale or combined with an administration or indeed a pre-pack. So how are landlords going to react to those, and to what extent can they thwart the intent to rescue the business is quite an interesting question. CVAs obviously have been really topical in the market, and I think I'm not giving anything away in saying that landlords really hate CVAs, and they think that they're really unfair, because typically what happens is the tenants divide the properties into sort of profitable and unprofitable, and then reduce the rent by a percentage on the unprofitable properties so that they can return the business to profitability. And there'll be different categories of property with different levels of rent reduction. But the balance of creditors tend to not be that affected at all. And there were a series of challenges pre-COVID where landlords sought to say to the courts, this isn't fair. Particularly Debenhams and New Look, there were court cases on both of those. And the court said it is fair. Obviously, it depends on the facts. It has to be fair on the facts. It has to be done properly. But there's nothing conceptually preventing a compromise of future rent. So I think we're not going to see any more sort of conceptual challenges to the whole thing, but you're likely to see fact-based challenges where landlords say to tenants proposing CVAs that our property is in the wrong category, or they try to argue to be bumped up to a better category in return for voting in support. Or indeed, after the CVA has taken place, one of the things the court said is that in order for it to be fair, if you're compromising the rent, you have to give the landlord a termination right, so they have a choice whether to accept that reduced rent or to take the property back. And we see quite a lot of our landlord clients who do serve strategic termination notices, where they're going to take a punt on either the existing business will negotiate better terms in order to be allowed to stay, or they will take their chances elsewhere. So I think if you're looking at CVA, you can't be sure you're going to be able to keep the properties where the rent is compromised. Is a sort of takeaway point. Asset sales aren't without sort of scope for landlords to try and thwart them either. And again, it's going to depend upon whether the landlord's got a better prospect out there as to whether it's going to want to try to thwart it. Some landlords would be very, very happy with the thought of a new co with perhaps a better covenant strength. But the two sort of sticking points with asset sales are that invariably the business is transferred on day one, and you need to, in almost all circumstances, you're going to need to get landlord's consent to assign the lease, and that's a process that can take a few weeks or months. And so the new co or the buyer will be allowed to occupy the premises under a license pending that application for consent to sign. So your first problem is that temporary occupation will normally be a breach of the lease, which will give landlords scope to try to forfeit the lease if they want. Even if you're in administration, that isn't a perfect answer to that risk, because once the business has been sold and therefore the company and administration has got no further economic interest in the new co continuing to occupy the property, then landlords are likely to be able to get permission to forfeit the lease if there is a breach that hasn't been remedied. And then you've got also the bigger position of needing consent to assign. And the sort of good and bad news here. So the bad news is that leases normally have circumstances in which landlords can withhold consent or conditions that they're allowed to impose. And you need to look at each lease individually to see what your prospects are. But some leases will require payment of all historic arrears and will invariably be a need to give sufficient security for the new co. And the outgoing tenant in many cases will have to give what's called an authorised guarantee agreement, and that can be a problem in insolvency because some insolvency practitioners won't want to give that, and therefore it gives landlords a sort of leverage to say, actually, I'm not going to allow you to assign. And or if you want to vary the lease because of your plans for the future of the business, that may also not be possible. And then the good news story, I think, though, is that if you can get over those hurdles of those satisfying those preconditions, landlords have to act reasonably. And the law is actually quite, once you get into the context of reasonableness, the law is actually quite tenant friendly. And so there's quite a lot you can do to put pressure on landlords. And therefore, it's really quite important to have a really well thought through strategy and not just wait until after the business sale and then think about it then. And obviously that will contrast with a share sale. If you were to do a share sale, it's much easier on day one because the business just continues as normal under its new ownership, and leases very rarely contain any change of control provisions. But the downside, the obvious downside of the business sale is that you've then got all of the liabilities of the business to deal with. And on the real estate side, you're going to have to look at this sort of future right sizing of the property portfolio and whether you've got sufficient break rights or lease expiries coming up to be able to exit the non-performing properties. And obviously there's then potential dilapidations liabilities as well for those properties that you are exiting. So yeah, there's quite a few interesting angles there that can be exploited by landlords.
Yeah, I mean, it sounds like it's really important to be across your leases well in advance, or as far in advance as you can be, ahead of any of these processes. Just in terms of sort of looking ahead to potential sale or processes, what other points should management teams, sellers or investors be thinking about in terms of planning for these kind of events in, because obviously things can end up moving quite quickly in the end, but well, what would your tips be in terms of planning?
I'll give one tip depending on which side you're on. So on the sales side of thing, my view is early engagement is critical with stakeholders. Obviously depends on who those stakeholders are, but it is absolutely vital whether they're creditors, secured creditors, key suppliers, landlords, and so on. Early engagement will assist depending on the plan. You know, if it's inside an insolvency process, there are certain creditors you're going to be speaking to and certain people you're not going to be speaking to. If it's outside of a process, that changes. But I cannot stress enough early engagement on the sort of company side, debtor side, about what you're going to do. By contrast, on the buyer side, a tip I've seen a lot advising buyers acquiring out of insolvency or acquiring distressed businesses is don't be afraid to engage buy-side insolvency advisors. You know, when you're buying out of a process or buying subject to a process, it is nuanced, and their experience that I've seen can assist on negotiations and two on the integration and how to deal with it the other side. It's certainly something to take advantage of, and on the larger business acquisitions I've seen, it's very useful.
And Sophie, appreciate you spoke at length before, but is there any sort of final sort of strategy points that you'd want to to make in terms of dealing with landlords in these kind of scenarios?
Yeah, so I think it's really the point that you picked up, Adam, which is sort of preparation, that you need to have a really good handle on your property portfolio, you know, which stores you want to keep or properties you want to keep and which you don't. If you're doing an asset sale, obviously, as well as that, you then need to work out your strategy for dealing with your consent to assign application, and it's worth being prepared with a sort of pack that, you know, you're ready to go the minute the business sale completes. You hit landlords with a pack and you've got a very organised sort of follow-up strategy, and that can really make the difference. If you're doing a share sale, I think it's more about looking at your future liabilities and your exit process and not underestimating the complexities of real estate law. For example, if you've got a break option and a lease, it seems very straightforward. You just send a notice to the landlord to say, I don't want the lease to continue beyond, you know, X date. But there are so many court cases where people trip themselves up over that, and there's so many things that you wouldn't think about as being a pitfall. So it's really important to get really in-depth professional advice, because it will save you a lot of angst and potential cost in the long term. If you are implementing a CVA, I think the key thing is just get a real estate lawyer involved in the drafting. They tend to be drafted by people who don't have that real estate experience, and they don't necessarily work in pure real estate terms, and it can make it a bit awkward trying to implement them. So those would be my top tips.
Thank you. Daniel, just coming back to you on the debt side, what do you see as driving the transactions from a debt perspective?
It's interesting to hear Sophie talk about those landlord attitudes. You know, Ian talking about HMRC clearing banks as stakeholders, and actually where those drivers are going to come from, and what's going to push things into default, into distress, and into M&A opportunity. As I said before, and Sophie echoed, whilst the debt burden on companies and the state of the balance sheet is obviously going to have an impact, and that's heavily driven by those government incentives and the liquidity that's been taken on. I'm not sure it is going to be lenders who end up driving those processes, certainly in the first wave. And actually, when you look at the mid-market, and certainly in the sponsor-backed mid-market, you know, the docs may not even allow traditional distress-style investors to actually get hold of the debt to push those situations forward, because of the restrictions on transfers that you know, lawyers like us at Stephenson Harwood work so hard to put in for our borrower clients. You know, that said, we'll definitely get to the point where lenders, you know, and investors can't wait any longer, and I think time in itself will drive M&A activities, workouts, or, you know, in terms of like Ian talked about, the shopping centres, which, you know, I know we've seen a couple at Stephenson Harwood, investors just not wanting to continue to invest more time and money into assets, and handing the keys back or handing the keys over to the lenders. Just to pick up, as Stuart mentioned at the outset, as I mentioned earlier on, you know, one of the big issues in adapting capital structures is that presence of government loan initiatives. All of those initiatives guarantee a high percentage of the debt, but they only kick in when there's no more money to squeeze out of a situation. So you are generally looking at having been through a formal and pretty final process. Now, the government has obviously spent a lot of time, effort, and money trying to avoid a wave of insolvencies, a wave of formal processes. So it's going to be interesting to see how the government actually honours those guarantees as we go forward and we do get into those default scenarios. It's going to be interesting to see if the government does actually offer any flexibility to those lenders, to those accredited lenders who've offered those government-backed initiatives, to be able to work with the debt, to be able to maximise a recovery outside of an insolvency process. But currently, you know, question, are the lenders of government-supported debt initiatives, are they in any way incentivized, at least, you know, financially, to right-size their part in capital structures if they are looking at a higher recovery in a formal or breakup scenario? just coming back to, in the hope that not everyone will end up in a formal process just because of the sheer debt on balance sheet. And the next step, as I said earlier, is for borrowers to look at their options, try and work it out, to try and work out what best suits them. Sophie talked about DD. DD is going to be massively important, and the best chance of that is to be able to do that in a consensual process. If I can recommend the previous session in this webinar series, our tax, litigation, reg and IP colleagues were talking about DD in the last session. Lenders will be as keen, and investors in distressed M&A or special sits M&A processes to work out what's there and where the pitfalls are. And as always in good times and bad times, investors are as concerned, lenders are as concerned as investors about the who as much as the what, and how to incentivize people who are going to steer the borrower through the next phase in their debt cycle.
Which leads us nicely to Nicholas. Nicholas, just on management teams and their incentivization, I guess there's sort of two aspects. There's dealing with what incentive arrangements are in place with these companies that are in difficulty, and then there's also the kind of looking to incentivize management teams going forward, if indeed you plan to retain those management teams going forward. Would you be able to just give us an apologies? I know time is a little bit tight, but we'd be very grateful for your perspective from management incentives.
Yes, well, I've come on last. Sometimes the issues with management incentives are really of a different magnitude. I can't come up with any legal or financial issues akin to an onerous lease or a looming loan, but management incentives we find in the interactions we have with clients are important. Not so much, I think, because of the existing ones give necessarily legal, or chat a bit about some of the issues we see, legal or financial issues, but of course the huge disappointment there is to the management team. And with incentives not generally paying out in the kind of situations we'll be discussing, they are unanchored. Now, just going through the DD process, if there's cash bonuses arrangements or others, then you would expect, just like normal variable remuneration, that there would be no payouts. They would just fall away. Similarly with stock options and other kinds of incentives, again, properly drafted, they will provide that they too fall away. All hugely disappointing, but legally certain. The area we sometimes have some issues with is where management hold actual shares. Again, I think battle scars people now provide, not just in the articles of association of the company, if the company is being sold, that is, as part of this process, that managers automatically sell their shares, often for minimal amounts, and they're generally stripped of voting rights as well. So they don't present a blockage in that sense. But and normally that's now backed up by participants when they enter into these arrangements at the outset, giving a very wide-ranging power of attorney, so that they sign away their shares and participate in all consent. But there are two things just like to chat about. One of which is, I'm sure people will read about this general relation to quoted companies, but we are seeing it in some private companies where, in event of corporate failure, management can be required to repay bonuses they've had, say, in the previous 3 years, and that certainly concentrates management's minds. At the moment, it is it's not in legislation, it's in best practice, but it can often be reflected in actual contracts. Normally, we don't see a great deal of this, but some companies have taken it up. So that's always one point to think of, and I think it will, as various legislative initiatives take place. In the event of more corporate insolvencies, then there may be further momentum on this. We'll see more coming on that. But the particular one is, and I know in our practice sessions for this today, we touched on this, where management have taken out loans to acquire equity. And so they're different in the position. Others may lose everything, but management then have to cough up more in terms of repaying their loans. And that's, aside from being painful, it gives rise to all sorts of issues. And I think I'm probably the first, possibly the last speaker to mention tax as a key issue, but if employees have loans waived, it effectively is a bonus. And I think we've all been scarred on these things, employees have. And Ian, I know when we were chatting about things, you said there was one way in which you saw just the banks take the loans off people.
Yeah, I mean,
keep the process through.
Yeah, I've seen a couple of distressed situations where management were still key to the business, and obviously that's a factor in itself, depending on how the failure has come about and or how the distressed situation is written. I have seen distressed investors acquire those loans as part of the acquisition process with a view to dealing with them in a tax efficient way post deal, because they want management on board and don't want management scared by the fact that you could see a liquidator coming after them for that loan.
Yeah, and I mean, I think I won't last, as I'm the pathway to the sunny uplands of the future. So putting in place management incentives at the time of the deal, which will, with luck, pay out when the business recovers. And sometimes there are obviously some very short-term arrangements. We see quite frequently arrangements are put in place just to get to the M&A. That's the survival of the company. Sometimes with tweaks, which is people have to remain in employment for 3 months afterwards, 6 months afterwards, if the buyer so desires. So you can see those sorts of things. But generally, it's more long term, and those can be any variety of arrangements. Cash is obviously key, and you can as each of my colleagues has been speaking, I've been seeing potential targets for the bonus payments, as and when a lease is sorted or a particular issue is sorted. That could be the trigger point for a partial payment of a partial bonus. We've also seen arrangements where payouts trigger repayment of debt if debt is the deal is debt funded. That perhaps isn't particularly optimistic about the equity getting great value, but at least it allows management to participate on the same terms. And the core part of this obviously is making management's interests coterminous with other stakeholders. So that's one that we've done, but it's not long before we get into involving management in the equity in these situations. And that is in many ways linked to the structure of transactions, but also linked to the tax. Cash bonuses paid to managers, I'm sure people know, are treated as income, and that is increasingly taxed with any number of employer social security supplements, which apprenticeship levy, health and social security, the list seems to increase, whereas a capital gain doesn't have those things and is taxed at 20%, or if you're particularly lucky, at 10%. And today isn't the sort of day for getting into these schemes. And I know Stuart's firm also has good people who can advise on the sort of detail of the commercial packages that should be put in place. But the workhorse in our area is something called growth shares. And that's not just limited to distressed M&A, it can be put in any company. And the key thing is management receive a class of equity with bluntly subsidiary voting rights and other rights to control the business. But we put in place arrangements where they don't have voting rights, they automatically sell, they're automatically taken away when people leave. So they provide no sector, but they receive value on a sale or exit of the business. And normally that's just the growth in value. Now on a distressed M&A, the equity may have very little value at the start, so it could normally be a percentage of the whole. In other cases, it may be appropriate to tier it. And you can put targets in, for example, you could get X% above 50 million, X% above, Y% above 20 million. You can see how these things expand. Aside from some of the distress, this is generally a hot market at the moment for employee and employee retention. As I say, people may be very disappointed in terms of what they've received for working for the company. And one of the dichotomies in my area is that although the incentives may not pay out on an M&A, you will speak to the individual executives and they will say, I have never worked harder to keep this business going. It is inherently unfair that I walk away with nothing. And that these are things that all just have to be managed. But as I see, just coming to the end of my sort of slot, one of the big killers for doing too much, and just not to encourage people to do too much too early, is that these things do require time to put in place, and working out who's going to get what, agreeing with all the stakeholders what the pot is, and getting a valuation, which is needed, and valuations take time from employee share valuers. You just can't get one within a week. It's a question of months. All mean that sometimes I think better judgment is to agree these things in a kind of heads of terms, so the management, particularly incoming management, if they're being brought on board and want the certainty of this, have the assurance that something will be done and done relatively quickly before the equity rises in value, and then these things are done in the sort of weeks after the event. When you, in many cases, you can often tell everyone about the deal. I mean, that's often one of the problems too in this, that it's kept very, very close there. Equity at the top company, or also potentially in a subsidiary company away from the debt, can give some very good results to management and incentivize them and reward them appropriately. So sort of end by saying clean management, key part of the human capital in all of this, got to be kept on board, sometimes even recruited in these situations. Whether it's short term or long term, or the kind of instruments you're using, we find with clients that it's a key part of the strategy of getting out of these difficult situations and putting the businesses back on the road to recovery.
Thanks, Nicholas. We're running close to the end of the slot, so I'll look to wrap it up there. Thank you to everyone for their thoughts, and obviously it's very, very, very important to keep a dialogue going with your key stakeholders in preparation for what might be coming. Particular thanks to Stuart Deacon, our guest speaker today, and I'll leave it to Stuart or I'll invite Stuart to finish with any closing thoughts that he might have. Thank you, Stuart.
Thanks, Adam. So I think my closing comments would be that the time for distressed M&A is coming soon, probably towards the end of this year, Q4 of 2022. Downturns are an important feature of the economic cycles that we inhabit. We haven't seen one since the global financial crisis of 08-09, and therefore we're probably a little bit less experienced on this than we perhaps should be. And therefore companies and investors do need to develop that toolkit to deal with these challenges and make plans in advance. I think the key theme that's come out from all of the distinguished speakers today is that planning, preparation, and early engagement is key to any successful business rescue. Thanks, Adam.
Thank you, and thank you everybody for attending this seminar. As I mentioned at the start, it is being recorded, so it'll be available on our website after the event. Enjoy the rest of your days. I hope you found it useful, and thanks again for joining. Thank you.